Hey guys, Nels Larsen CPA at Guidance Accounting here. Wanted to spend a couple minutes chatting with you about 1031 like-kind exchanges. Now you may have some general idea what they are. I'm not going to go into a lot of detail because you can certainly get caught up in the weeds. This is just kind of an overview for a couple minutes. So 1031 like-kind exchanges, it's a tax tool that you can use to defer taxes or even permanently defer taxes if you own real estate. So this is something that's going to be really pertinent to real estate investors, or if you own an operating business and you happen to own the building that you operate in. So the way a 1031 like-kind exchange comes from, first I should just break that down. 1031 is just this section of the Internal Revenue Code, so that's what that is. So 1031 like-kind exchanges are where you own a piece of real estate as long as it's being used for business purposes. So you could sell it, and then you have a total of 180 days, or almost exactly half a year, to buy a replacement, quote unquote, replacement piece of property. And one of the tricks, or one of the keys, is when you sell your original property, you cannot accept the cash. The proceeds from the sale, after maybe a mortgage has been paid off or mortgage and property taxes has been paid off, the proceeds from the sale have to go into a trust or an escrow account. They can't come into your personal account or your business account that you control. It's got to go into trust or escrow account. Most title companies that I'm familiar with offer this service, and they would be referred to as a QI, which is Qualified Intermediary, QI. And so they're basically going to help make sure that the 1031 is going according to plan. So you sell your property on day one. You want to buy a replacement property. You've got 45 days to identify your replacement property. And I think you can even identify multiple replacement properties. So you can go, well, I like building A, building B, and building C. And then you identify that within your 45-day window. And then you have an additional 135 days to actually close on a property. And interestingly enough, it doesn't actually have to be the property or properties that you identified in that initial 45-day window. Because maybe a deal falls through, maybe in your negotiations with one of the property owners of those other properties, things fall apart. As long as you've got a replacement property purchased and closed on within 180 days of the sale of your original property, you should be good, okay? But what happens is, so let's say, just to take an example, let's say you've got a property, it's worth $300,000, and your tax basis is $100,000. So let's say you took depreciation and then the building appreciated over whatever time frame you owned it. So your investment left in the building is $100,000. You sell it for $300,000. Instead of having a $200,000 capital gain that you've got to pay tax on, or it could be a capital gain combined with some depreciation recapture, that $200,000 of what would be taxable income, you actually roll the purchase into a new property. So new property, and it doesn't have to be identical property. You know, the property that you sold could be a warehouse that you had your operating business in, and the property you acquire could be a multi-family apartment building, or it could be 3 or 4 single-family homes you're going to rent out, or it could be an office building. You know, you get the idea. It could be, you know, any real property that's going to be used for business. And that $200,000 gain we had on the sale of our original property gets rolled into the new property. And you can do this, on, and this is how real estate investors, or one of the ways real estate investors, high net worth families build wealth, is you might own a building for 20 years, and let's just say the same, example I just gave, you've got a $200,000 profit, you roll that into another building, and let's say you own that building for another 20 years, so that's 40 years. And then at the end of 40 years, you're like, yeah, I'm going to buy yet another building. So you sell that second building, you go and you buy a third building, and let's say while you own that third building, you die. Your kids, spouse, whoever your heir or heirs are, they would actually inherit that third building that you owned when you died at the time you passed away, they would inherit that building, and they would actually inherit it at the fair market value at the time you died. So even though you may have all this profit from 2 previous buildings that you owned for multiple years rolled into this third building, all of a sudden that profit basically goes away. And let's say that that third building's worth $1 million fair market value. But let's say the profit from those 2 buildings that you had deferred was $600,000. Well, that $600,000 doesn't become taxable income. You get a step up in basis in that new building, the heirs do, and so nobody ultimately pays tax on that $600,000 that was deferred over a 40-year period of time, or 40-plus year period of time. So it's a very powerful tool. It's something obviously all real estate investors should be aware of, and anyone else who is even interested in playing in this field. Hope that helps. Hope it wasn't too confusing. If you've got questions, my email, contact information is down below. Please leave comments. Let me know your thoughts. Feedback is how I can do a better job of crafting the message for you, the audience. Thanks so much for watching. Have a great day.